It's the weekend and you have financial questions that need answering. That can only mean one thing. It's time for Jill on Money, the show that takes the mystery out of your finances. Here's your host, Jill Schlesinger.
Welcome to the Jill on Money show. I am Jill Schlesinger. Mark Talercio is running the operation, and we are delighted to chat with you. Remember, we are here to take the mystery out of your financial life. We love to hear from you, and that means you've got to send us your questions. Any financial question you have. That's it. It's so easy. Just send an email, and that email address is askjill@jillonmoney.com. Ask Jill at jillonmoney.com. And if you are on our website, maybe, just maybe, you're on the website. Why? Because you are subscribing to our sister broadcast, the Jill on Money podcast, which comes out every single day. And you don't want to miss a day without Jill and Mark. Maybe you've done that. Maybe you're on our website. You can just click the contact button and send us your question. And, you know, we're getting a ton of questions. There's no doubt about it. It's part of the reason that we launched a daily show because we couldn't keep up with all the emails. And so we came up with this idea way back when. When was that? That was almost a year ago, back in March of last year. And we said, let's just go daily and answer questions. So if you want more of us and you have questions, you're going to send us an email. We're backed up, I know. However, one great way to get to the front of the line, to get your question answered, is on that email that you send us. Just tell us, I would like to join you on the program. And then you'll skip the thousands of people who have sent emails ahead of you. How great is that? It's like a legit way to cut in line. Mark, you were never the kind of person who cut in line, were you? No, definitely not. I know. I remember when I was a skier about 100 years ago, there were certain people who kind of tried to sneak in. And I learned an old trick where you just put your pole in between somebody's two skis. Just prevent them from moving forward. It was quite excellent. But we're not going to do that. No traps for you. We'd love to hear from you. We are sponsored by Facet Wealth. Facet Wealth is our 2021 sponsor of this radio show. And what is great about Facet Wealth and why we're happy they are our sponsors is that Facet Wealth is trying to create financial planning that is accessible to everyone. So what's great about that is that there's no wealth or account minimums. And I think that that's a big hurdle that many people can't get over. I just don't have enough money to make it work. So Facet charges a flat fee for conflict-free planning. What does that mean? It means that they've got certified financial planners there giving advice and dedicated advisors, not someone who's a random advisor in a call center. You're going to get that same person. And that person, because he or she is a CFP, is a fiduciary. Is going to put your needs before the company's or his or her own needs. So that's what's really great. Facet meets you where you are. Join Facet Wealth by hopping onto their website, facetwealth.com. And you just heard Brent Weiss, the chief evangelist, certified financial planner himself. He was just on the show recently, and you can check out his show where we really focused on money and relationships, you know, the whole Valentine's thing. It's kind of great. Anyway, check it out, facetwealth.com. Okay. So let's get to some of your questions because you don't want to just hear me yammer on. You want to answer some questions? We got it. Okay. So here's a question from a 37-year-old guy named Chris. And he says, I've got a partner who is 40 and we own a house together. We are not married yet. We're planning to do so eventually. We are debating getting term life insurance to help cover the cost of the remaining mortgage. Now, I read and hear a lot about term life for people with kids. I've never heard anybody give advice on whether it makes sense to get term for a partner, unmarried, no kids. Okay, the reason behind this life insurance would be to make sure the other person, the survivor, doesn't have to worry about the house if one of us dies. We both have life insurance through work. We are each other's beneficiaries, and we're also beneficiaries on each other's work retirement accounts. So if I died today, this is what Chris writes. Without term life insurance, he, the partner, would get 263,000 from the retirement account and 140,000 from work life insurance. If he died today, I would get 115 from his work retirement and about 90 from his work life insurance. Okay, so now they're looking into getting 400 grand in life insurance in each of their names. It would cover almost the remaining mortgage for 20 years. The remaining mortgage is 435 grand, about 28 years left. We figured by 20 years, we shouldn't have that much left that we couldn't afford. Okay, we priced it out. $400,000, 20-year term, 264 a year and 534 for him. I just don't know if I'm being overly cautious and overinsured in my life. I love the work and the information that you and Mark give. Thanks for keeping us on track for our future selves. Okay, now, I think this is just fine. Here's the thing. I mean, the reason that you buy life insurance is to, if somebody suffers financially in the event that you predecease him or her. Okay. So that often will mean a lot more insurance when it comes to people who have kids, because when kids are young, you just don't have as many dollars and saved up, and you don't have an asset base that could support those kids going forward. However, for you guys, I think this is a great idea. I mean, I think you should make sure that you shop around because obviously term life insurance is certainly the cheapest, but it's sort of a commodity. So make sure you're getting the best price. I like the idea that, you've got this money, it's set aside, you're not going to have to worry about it. Obviously, as the mortgage progresses, you don't need as much because essentially the mortgage is getting paid down and you're also saving more, but it's not a bad idea just to have it. I think that you're in good shape in just getting that and getting it done. It's pretty cheap. Interesting though, Mark, that did you notice that the partners is so much more expensive? I wonder if the partner has any sort of pre-existing condition. It can't just be 3 years, right? Because the differential is quite big actually, right? It's $300 a year and it's I don't know, it's interesting to me. So anyway, I would for sure look at it and also maybe look at your work accounts and see if you can buy extra insurance at a more affordable price. As long as that insurance is portable, meaning you can take it with you, it might be a more cost-effective way to get the coverage. So you check with work, you check for cheaper insurance, make sure it's all there for you. And I think you guys could be onto something. That's all. I think that it's a good idea. And I don't think you're overinsured. I do think having enough insurance, it also puts your mind at ease for pretty short dollars. Check it out. Let us know how you do. And go check out policygenius.com also, because I think they've got a good aggregation service. Okay, you're listening to Jill on Money, and when we return, we're going to answer more of your questions. During the break, hop onto the website, jillonmoney.com, and sign up for our free weekly newsletter. We'll be right back.
Back to Jill on Money, where Jill Schlesinger helps you take the mystery out of your finances.
You're back. It's Jill on Money. If you have a financial question, we'd love to hear from you. Our email address is askjill@jillonmoney.com. That's askjill@jillonmoney.com. Okay, I had a question here. Some of you folks listen to us on YouTube. And Mark, I've been asking you to take down all the comments because I think people are so mean, but this was actually a really interesting question that somebody put in, which was at age 59 and a half, a widow, a couple kids, retiring at 67 years and 10 months. I want to build at least 12 months of salary. He's got a 403B and a Roth, and just wanted to know recommendations, advice at Schwab, through Vanguard, or Facet Wealth. That was the question, I think, like which one? And I say, go talk to all of them and see what makes sense to you. I don't think that when you start listening to the program and we say we need more information, I just want you all to know that part of the reason I'm saying that is that, you've got to then take the information that I give back to you and try to put it in motion. Sometimes it's just trying out different services, what you like better. Some of it is the platform. So don't be afraid to poke around and talk to different folks and let us know what comes back to you. Okay? All right, let's go and talk to somebody live-ish. I call it live-ish. We've got Ryan, who's on the line from Seattle, and we are going to be talking about some real estate. We've been getting a lot of real estate questions. So, Ryan, how can we help you out?
Well, first, thanks for having me on the show. I appreciate it. Love listening to you. My wife and I are both partially retired, and we just sold our home, and we are thinking of buying our next home, which is going to be a downsized version. So I am 60. My wife is 54, and we have 2 kids in college and 1 kid that's out of college. And we're just deciding whether or not we want to take on a mortgage or not, because the homes here, as you probably know, are pretty pricey. And to get a decent home in a decent neighborhood, I don't think I want to pay all cash this time and totally eliminate my liquidity.
So let's do a little bit of sort of the big picture stuff. So you're retired. I presume that means you saved a chunk of money. So you want to give me just a quick rundown on asset level?
Sure. And I should say we do both work part-time. So we do bring in about $60,000 a year.
Okay. Got it. Tell me what else is going on.
All right. So we have 529s that are fully funded with about 120 in them, Roths with 38,000, a small HSA with 8,000. I have an old 401k with 475,000. I have an IRA with about $1 million. I've got a pension that's going to be coming at age 65. That'll pay about $3,600 a month.
That's nice.
Yep. And then my wife will have a pension with her new job that she just started with the state. But I just don't have a good feel yet of what that's going to look like. But I would think it's going to be a couple hundred a month down the road. And then we're sitting on about $600,000 worth of cash.
Say that ways. It was how much cash was that that you have?
$690.
$690, and that is from the house, or is that in addition to your emergency reserve fund, or is that all wrapped up in one big cash account?
One big cash account.
How much is really your emergency reserve fund? In other words, how much money are you guys spending?
Well, we burn through about $5,000 to $5,500 per month.
So right now, the $60 grand a year that you're making part-time doesn't cover your expenses. Are you using some of the money from the cash to float you to your lifestyle?
A little bit, yeah.
Okay. Not a ton though, right?
No.
Okay. So we got to keep 100 of the 690 liquid at least, right?
I think so.
Okay. What kind of house do we have to buy? How much do I have to spend?
You're looking somewhere in the 6.25 to 7.25 range.
All right, let's say 700 grand. So what are you thinking about what you want to put down? If you could wave a magic wand, what would it be?
$500,000.
You want to put down $500,000?
Yeah.
Why? Look at me, I'm whining. Could I maybe say, what about 350? 350 seems like a good number to put down. And money's cheap right now.
I know, but I just don't like debt.
I understand that. I think of life as one big mathematical equation sometimes. Are you in the technology sector? Just because you're in Seattle, I was wondering.
No, but I do work with a lot of tech people.
It's just sort of like the idea here is that, even if you really hate debt, let's just say you got a 15-year mortgage, okay? The cost of that money is so cheap right now. And the availability of what you could do with that cash, even just to have the liquidity of the cash, is so much greater. So on one hand, I think you'll make more money with your money than let's call it 3% for a 15-year mortgage. It's probably less than that. And I like you having liquidity. I like you having money. You still have a couple kids in college. I get it that, it's fully funded, but truly you're young. And I think that having control over your assets, not having paid off homes, actually gives you more control in the long run. I really do. And like you said, you're going to have a good, let's just pretend that your wife gets $400 a month. So let's just say your pensions end up being $4,000 a month, and then you're going to get Social Security on top of that. I presume you're going to be waiting till 70. A lot of your needs are covered. All you'll be able to do with that cash is to have flexibility. I know that when people go out and look for houses, all of a sudden it's not 700, it'll be 800. You know how that happens? I mean, you can always pay it down. You really can. But if all of a sudden you're like, you know what, I don't really want to work part-time anymore. She's going to work part-time, and I need some of this cash to live on before age 70. I just think that having the cash in your grasp is really important, even if you just throw it into a very boring, balanced account, right? I don't know. I feel very much that, you're young and having money available to you. You could make a different decision. Let's say you're 70 years old and you've got tons and tons of money and life has been fantastic to you. So pay it down. You can pay it down then, but you'll have a lot more information, after the kids are out of college, and you'll have more information about like what the path forward is for you guys. If you put 500 grand down and you have a smaller mortgage, it sort of feels good emotionally. But on the other hand, you don't have the money. When you're 70, my guess is interest rates will be higher and you won't have the opportunity. So why not take the opportunity now to give yourself what in the investment world we call a free look? You can look, you can see, okay, good, I'm in great shape. Boom, done. That to me is actually a more conservative approach. It doesn't seem like it, right? You say to yourself, oh my God, to be conservative, I have no debt. To be conservative is you have more cash or access to money or liquidity, and that gives me many more options. God forbid something bad happens. You have the cash, you have the money. How do you feel about this?
Brand new, wasn't expecting it, so I appreciate it. Gives me something to think about. So what about the kind of almost $1.5 million in the retirement accounts, in addition to the pension? I mean, how are you thinking about that?
I'm thinking about it that it's awesome. You have it. It's great. It's taxable. I mean, look, I think you're in great shape for retirement. I think you know that. It's just that a lot of your money is in retirement accounts, right? So, when you think about all the money you have, you don't have that much liquidity. Basically, you have the small Roth, but you don't have money that's already been taxed. And I think you're going to need that money between age 60 and 70. That's what I think. Think about it. If you want more hand-holding, you can get numbers and all that. But just remember, flexibility. That's about the most conservative approach you can take. It feels weird, but I want you to at least consider it, okay?
Yes, I will.
So thank you so much for giving us a shout. I really do appreciate it.
Thank you, Jill.
Okay, we'll get back to the Jill on Money show in just a minute. So here's something that's interesting that you could do right now during the break, which is you can go to jillonmoney.com and bookmark it. Make it your favorite. Pop it right in there. As soon as your Gmail pops up, pop up Jill on Money. We put different stuff on there all the time. jillonmoney.com is the website, and we will be right back.
Do I invest here? Should I put my money there? Jill Schlesinger can help you. Back to Jill on Money.
You're back. It's Jill on Money, and we are broadcasting from the Capital One Bank virtual studios. Capital One, this is banking reimagined. What's in your wallet? Hey, Mark, you know what I did over last weekend, the long weekend, when I was thought I would just relax and binge millions of things? I ended up getting not just one, but two new iPhones. And I'm sure that I got completely ripped off in this process. But as soon as it was like one of us had one phone that was different than the other and plugs were changing and one would be on 5G, the other one wouldn't, we were like, forget it. We just did it. So I made myself insane with all of that Apple upgrading. I'm so deep in the Apple ecosystem. There's no way I'm out now. It is exactly what they want to do. Where I like put my foot down. I'm like, I'm not buying another extra Apple plug. I just bought an extra Anchor plug instead. Okay. Anyway, this is the program that takes the mystery out of your financial life. And the mystery is often, how do we get into these places where we are just stuck in these ecosystems? Man, at least I've broken out of my streaming ecosystems. So that's good. I just watched a really weird one and I'm finishing up now, Losing Alice on Apple Plus. Woo, a little freaky. Let's see. We have a long email question from Tom. If you've got a question and you want to give us a shout, it's askjill@jillonmoney.com. And here's the subject: a deer in the headlights, ! Recent federal retiree confused about how to proceed with the thrift savings plan funds. Okay. Excellent. Tom writes, "Hi, Jill. I've listened to your podcast. Since you started it, I never miss an episode. Isn't that nice? Also bought the book and I watch you on CBS this morning." This is a real fan. Thank you so much, Tom. Tom says, "I'd like to get your opinion on what I should do in my situation. I am 56. My wife of 33 years is 55. After a rewarding 38-year career, darn, that's a long time, I retired from the federal government in early 2019. I immediately began work as a contractor. This is a lot of people do this, by the way, and which is great because you get your benefits in and then you can still make money. Okay, he's making $155,000. Now, the plan was to continue working as a contractor through 2021 at least, but by October 2020, it became clear that some profound changes were about to take place in my career field, and it very much felt like it was time for me to go. So I resigned from the company in December 2020. This is all new. I'm currently enjoying my retirement honeymoon phase. I love having time to pursue projects and do what I want. I expect I'll take a job at some point to bring in some more spending money and to plug in socially, but not yet. My wife works for a private college. She makes about 50 grand a year. She took the job there over a decade ago, mainly to take advantage of a tuition support scholarship program benefit offered by the college. How amazing is this? It enabled us to put our 3 kids through college without bankrupting ourselves or our kids, and it worked out very well. My wife plans to retire from the college sometime this summer. She plans to work again too, sometime, somewhere, but we know we can live off of my pension. Okay, here are the numbers. I draw an annual pension of $112,000. It covers our living expenses with a little bit of cushion to spare. We get our health insurance through the federal government. I chose a full survivor's annuity for my wife, which will give her 60% of my pension. He writes, should I croak first? I didn't say that, he did. I purchased a $500,000 term life insurance policy to fill that loss, meaning that this is actually a very smart way to use insurance sometimes, is to get, it's basically the gap of when you take a haircut in your pension. So she's only going to get 60%. He wants her to have this extra $500,000 because it's not 100%. Okay, she's also going to get Social Security. He's not available to that. Okay, they owe $181,000 on a 30-year mortgage at 3.75%. House is valued at $370,000. We're in no hurry to pay it off. We'll live here for at least another decade. We're not carrying other debt. I have $605,000 in a traditional 401k in the thrift savings plan. The Roth wasn't an option until late in my career. I haven't made any changes yet to my aggressive allocation, which is basically 70 stocks, 30 bonds. He also has a Roth 401k at T. Rowe through the contractor company. There's only about 21 grand in it. I'll probably roll it over to a Roth at some point, a Roth IRA at some point. My wife has 150,000 in a 403b from the college. I'm sure that we'll roll that over to an IRA at Vanguard or somewhere else like that. 75 grand in cash. We plan to buy some sort of long-term care coverage. We'll get some advice on that. I think we fall in the category of people who need it. I don't know if you do. I don't know I'm not sure that you do need it, but okay. So here's the quandary. I want to stay somewhat aggressive in my thrift savings because I want it to keep growing, but I also want to take occasional withdrawals when we want to splurge on something. And I plan to leave my money there. It's done well for me and has low fees. I can take withdrawals penalty free and I don't have to wait until I'm 59 and a half. I talked to the accountant doing our taxes. He advised leaving the money there and paying the taxes as we take withdrawals. It seems to make sense. It's not feasible for me to do a backdoor Roth. No, we're not going to do that. I'm hesitant to even begin trying. And yeah, you make too much money. I get that. So, I think that he's worried about getting nailed on taxes later in life. Because we have all this money that's pre-tax. And he says, I don't see a realistic way around it. Is it stupid to just take periodic withdrawals, probably mostly within the next 10 years, and pay the taxes as we go? No, it's not. I mean, if you want to, so I don't think that that's a problem. I really don't. I think that, in fact, in some respects, the only bit that I would think about is that if you wanted to do that after your wife stopped working, potentially, I guess, and you were only drawing that pension of $112,000, then you could convert some portion of it. But I wouldn't go crazy. I really wouldn't. You got a lot of money. You got plenty saved. And frankly, if you are, you're especially in the next 10 years, you pull it out a little bit at a time as you need it. It seems fine. And maybe the only time you think about a conversion would be if you were in one unique year where your income was way lower than it is. I think that's it. I mean, you can keep it aggressive. Just whatever you think you're going to need in that account, make sure it's sitting in cash for the 12 months that lie ahead. So any money you need within 12 months stays in money market. Otherwise, enjoy the ride. And thanks for writing. Okay, you're listening to Jill on Money. If you've got a financial question, we'd love to hear from you. Send us an email. Ask Jill at jillonmoney.com. We'll be right back.
(401ks, IRAs, refinancing, she covers it all. Back to Jill on Money with Jill Schlesinger.
You're back. It's Jill on Money. This is the program that attempts to take the mystery out of your financial lives. I mean, look, I can't do it all. I need your help. And I really want you all to know that we are here for you. Mark and I are here for you. It's been interesting to cull all of the questions. You go back a year ago and you think, gosh, we got so many questions where people were freaking out. And now, boy, are we getting those questions all about, a little bit more risk, or I like the risk in my account. I don't know. That's what I thought about when I got this email from Michael, whose subject is margin. Margin is a way to use borrowed money on your investment account. So Michael says, I'd like to start out by saying that I've been listening to your show since the pandemic started. I love it. I have a dog that I would love to be on the wall of fame. That is the furry fan club. And you ought to, did we get a picture or not, Mark? Send it in, Michael. Come on. Let's get to Michael's problem here. I have a self-directed account with $180,000. It's just a plain old non-retirement account. He says, I applied for a margin account to increase my investing base. A margin account, again, means that you can use borrowed money from the investment firm and you can lever up your investing, meaning you can use borrowed money. And if your bet wins, man, you've actually got a better return on your investment, right? Because you put a smaller dollars to work. You put some of the borrowed money to work and some of your own money, and it kind of amplifies the performance. Of course, that's if you make money. If you lose money, it amplifies your losses. Okay. Michael's 38. He makes 80 grand. It's a stable job. He's single. He's got no kids in San Diego. You know what he has? Too much time on his hands to be thinking about this. He's got 200 grand in various 401ks from previous and current job. Is it a good idea to margin? He's asking basically, should he margin this account, use borrowed money, and just pop it in the S&P 500? No, you shouldn't. This is a dumb thing to do. First of all, Mark, does it strike you as interesting? He's 38 years old. He only has 200 grand saved. What's up with that? Stop messing around with your margin accounts and thinking about what it's going to do and put more money into your retirement account, right? Are you not maxing your retirement account? Michael, Michael, are you listening to me? I sound like a mother, don't I? I mean, I think margin, if you want to play around with margin, you want to see how that works, great. Don't call me when the market goes down. Okay. Don't call me when you get a margin call. Okay. How's that? Oh my God. If this doesn't show you, Mark, that we are in a frothy part of the investment cycle, woo, I don't know what does. That's not a good sign, is it? Keep it simple, stupid. Anyway, another Michael says that he's recently changed jobs, and part of the separation agreement, he's got $1 million in cash. Ooh, after tax. And a 401k with $400,000, half traditional, half Roth. He's 100% debt free. Retirement is 12 years out. I don't intend to use any of the investment until after retirement. Future savings will be 50 grand a year, and he's maxing out his 401k. Question: what do I do with the cash and the 401k? He didn't tell us how much money he makes, did he? I mean, he must make enough money because he's able to max everything out. He says he's talked to several investment groups. Strategies vary widely. Annuity, stocks, bonds. I'm not overly confident in the reviews that I've received, and so I'm reaching out for your potential direction. I want to know more about you. First of all, can you do this yourself? Is there any reason why we really do need an investment professional involved? That's the first question. Now, if you don't want to do it yourself, then I think you're asking me, what no to an annuity, obviously. But do you need a real financial planner or do you need an asset manager? Those are two very different things. You want just someone to manage your assets. You just want to have this thing go on autopilot. That's a piece of cake. You don't need an individual to do that. You can pick any robo advisor. You could even get a little bit of help from Vanguard Personal Service Advisor, Schwab Intelligent Portfolio. Vanguard has a digital advisor product that's just basically a robo advisor. It's totally, I think, sort of hassle free. However, if you want customized financial advice, then you're talking about investment advisory firms. You're talking about one-on-one. You're talking about paying 1% or so. Or you could check out our sponsor, Facet Wealth, and see what they're up to and see if they might be able to help you out. That'll be a flat fee. It's not going to be free. It's not going to be as cheap probably as the Vanguard or the Schwab alternatives, but it might be less expensive than a customized financial planning firm. But I'd love to know more about you, Michael. I feel like you are so close to maybe making a decision that's going to be really important for you. And we just want to make a smarter decision, and we just need some more details. So please, please follow up with us. Tell us how much you make, or maybe join us on the air because Mark could arrange that. I'd love to know a little bit more about you and your experience managing your own money. Okay, before we go to the break, I want to remind you that you can go to our website, jillonmoney.com, and you can read all the stuff that I write. You can listen to old shows, and you can watch segments from television that are really kind of cool. My last one about tax planning, that's going to come up next hour. It's very exciting. So if you want a little more of a deep dive on tax planning, that's coming up next hour. But before that, we're going to do more of your questions. So it's Jill on Money, and we'll be right back. You're back. It is Jill on Money. And before we finish up the hour, we've got more questions to answer. Anita writes, by the way, Anita, this is awesome. I'm going to tell you why in a second. I am 94 years old. So first of all, she's 94 and using email, which I love because my mother, who's 81, not so adept at the same process. Let's just go there. Okay. Anita is 94. She says, I'm disabled and low income. I've been offered an unknown amount of money through the current economic impact program, but the staff there refuses to answer questions unless I sign up first. That sounds like a dangerous step. Please advise me as to how I can get the money due without any complications. Thank you. Yeah, don't do this. I don't know what economic impact program is, but here's a question. Number one, did you receive stimulus last year? And if not, you will probably do it. And if you're on some sort of SSDI, if you're disabled, and if you've had low income, you probably should have gotten that automatically. You don't need to apply for it. If for some reason you did not get it, and you should have gotten it, because based on the facts that you just relayed, you should have gotten it, then you may want to go onto the irs.gov website, and there's a way to say, I didn't get my stimulus check and I think I got it. But don't give your information to anyone. Your antenna served you well, because I think that this sounds totally like a scam. So let's try to make sure that you don't do anything like that. And for anyone else who's listening, again, if you did not get your stimulus payment and you think you're due it, if you go to irs.gov, the first thing that comes up, it says get my payment, and you click on it. If you didn't get the full payment, you may be eligible to claim what's called the recovery rebate credit. Go to irs.gov. The information is right there, and it will lead you to all the places you need to go. Okay, we're going to be talking a lot more about taxes because it is time for our favorite return guest, Ed Slott. He is a CPA. He is an expert in everything IRA, and he is joining us next hour. We're going deep and we're doing our taxes. So stay tuned. It's Jill on Money. When we return, one of our favorite guests of all, it's the miracle called Ed Slott. We'll be right back.
It's the weekend, and that can only mean one thing. You're listening to Jill on Money, the show that takes the mystery out of your finances. Here's your host, Jill Schlesinger.
You're back. It's hour number 2 of the Jill on Money show, and we are so glad you are joining us and hanging in there with us. And we are going deep into taxes. Tax season opened on February 12th. And by now, you should have most of your tax documentation, not everything. I know a lot of you might have some investment accounts, and that can sometimes take a little bit longer, but, keep refreshing. And if you've moved around, just go to the websites to get the information you need. It's so much easier to just have that in your hands. So for this hour, we have return guest, Ed Slott. You know him as the IRA expert. In fact, his website is called irahelp.com. He's been on the program a number of times. He has been generous with his time and is helping us make sense of this tax season. So one of the things that we're really going to concentrate on first are some of the implications of the COVID relief plans and how they may mess up some of your tax planning. And then we'll go into more general stuff. So here is the beginning of a fantastic hour that we spent with Ed Slott. So let's start with this tax season. The year 2020 was such a crazy year. What are the significant things that people need to pay attention to that are directly related to this COVID horrible crisis in 2020? What do they need to know about their taxes, Ed?
Well, everybody has different transitions they've gone through. There's been massive layoffs of people lost their job. Lots of people got unemployment during the year. That's one we can stop on because I don't know if it's well known, and I have a feeling it isn't, but many people who got the $600 a week or whatever they were getting at the end of the year, that's taxable. That money may have already been spent, and now they probably have already received a 1099 and say, what's this? Who has the money for that? I've already spent that money. So just so you know, that's taxable. Not much you can do about it now, but I don't think many people realize that.
Is there a way that if, there are people who are going to continue to receive unemployment benefits either through their state or through the federal program, can you have withholding done on your behalf through?
Oh, yeah. Yeah.
You can, but it doesn't make it easy. Like, it seems to me that maybe it got lost in the shuffle that a lot of people, you're right, did not know about that.
Right. And they may get a surprise. Maybe they were smart enough to have withholding, but, a lot of people that were desperate didn't take withholding because they needed every cent. But if there's a silver lining, if they had low income, their tax rates may be very low or nothing at all, depending on how low the income is.
So besides the unemployment, I'm sure that you get this question about a million times. Any stimulus check that is not taxable income. Is that correct?
Right. And you can take it as a credit. It's like a credit. If you didn't get it, you get the credit. It's like you paid tax in, like a tax payment.
Wait, explain how that works. I need to understand that better.
Well, let's say you didn't get your payment, so you can take a credit. Some people, there was, not everybody got all the checks they were supposed to get. So some people didn't get them. So you get them in the form of a credit if you didn't get an actual check.
Interesting. Okay. So other things that happened last year in 2020 included that through the CARES Act, that first one from the springtime, people didn't have to take their required minimum distributions. Do you think that that's going to get waived again in 2021?
I don't think so. First of all, I didn't think that was of much help anyway, personally. If you think about it, let's just go back to the law. Congress tends to overreact and they go, RMDs, people are screaming, things are bad. All right, stop all the RMDs. Now, by the IRS's estimates alone, 80% of the people who take RMDs take more than they have to because they need the money. So how does not having to take an RMD that you need anyway help you if you're going to need it anyway? So it only really helps the people who didn't need the money. So, of course, they don't have to take it. So the difference now is what changes in 21, they resume. 2021 RMDs, required minimum distributions, resume based on the regular calculation that it would have been anyway. Some people have asked, do you have to double up because you didn't take it in 2020? No such thing. You take your regular RMD, but they're back.
Okay, so we've talked about a couple of the aspects of the CARES Act. One thing was this relief for retirement accounts. And I remember when I spoke to you way back when, you weren't psyched about this, that there was a rule in the CARES Act that said no 10% early distribution penalty for folks who are taking money from their retirement accounts. And the tax would be due and could be spread evenly over 3 years. Now, you didn't like this, right?
Well, in general, taking money early from a retirement account is one of the worst financial moves you can make because what's going to be left for retirement? So Congress always does this. On one hand, they tell people, save for retirement, put away. We're going to give you all these incentives. As soon as something happens, they say, we'll give you a way to get that money out early, and then you have nothing for later. So they did it with the Secure Act. They put in an exemption from the 10% early distribution penalty, people under 59 and a half, for birth and adoption. Well, if you're just starting a family, is that what you want to do? Start hitting your retirement account when you have your first child or any child? So the whole idea of dipping into or rating your retirement savings early is not a good long-term plan. But I also get that if all other avenues are dead ends, if you're in dire financial straits, this should be really a last resort. If you can't pay rent, you can't eat. I mean, there are emergencies, and if there's no other money, then this is a good provision.
And when you actually report this, where does this go on your tax return? You've essentially made a coronavirus retirement distribution. Where do you show this on your tax returns?
Well, it's going to show up as income, but they gave people a good deal. First part of the good deal is, as we just said, if you're under 59 and a half, there's no 10% penalty. You could spread the tax over the income over 3 years. So let's say you took 60,000. You were allowed to take up to 100,000 from your whole collection of retirement accounts together, your aggregate. So let's say you took 60,000. You had the ability to spread the income over 3 years, 20, 21, and 22, 20,000 a year. Or if you want, you could report all of it in 1 year. Now, you might say, why would anybody do that? Well, maybe 20 was a lousy year, which it was for lots of people. Maybe you were in the lowest bracket you ever were because of reduced income, and you just want to put the income in this year while you're in a very low tax bracket, especially if you expect your income to hopefully spring back in 21 and 22. So you could report it all in 1 year or over 3 years. If things turn around for you, and this is a great provision, you can repay it. You have up to 3 years to repay it. So that's where this new form comes out, Form 8915-E, as in Ed Slott.
I know they knew they named it after you. That's so awesome. You finally got your due from the IRS.
Yeah, right.
We'll get back to our interview with Ed Slott in just a minute. Hey, you know what you could do during the break? Why don't you grab a file together if you happen to be, when you're listening at home at your own pace, or when you get home from wherever you're listening to this, just start organizing your tax stuff. Just throw it in a file. Just call it 2020 taxes. That's all I ask. That's it. It's so easy. Okay, when we return, more of our interview with Ed Slott.
Back to Jill on Money, where Jill Schlesinger helps you take the mystery out of your finances.
You are back, and it is the Jill on Money program. And we thank you so much for hanging with us. We're talking taxes this hour with our friend Ed Slott. And, listen, so much of tax planning, you know what happens with it? You get very into this like sort of short-term exercise in diving into your financial life. And I think that's a great time to actually think about whether you should be taking a bigger, broader look at your financial life with a financial planner. And if you're going to do that, you got all the documents that have already kind of, sort of sparked some conversation in your own mind with a spouse, perhaps. And one of the things that I recommend is that you use tax planning time as a time to think about getting overall financial planning help. And you can do that from our sponsor, Facet Wealth. Facet Wealth has a beautiful program where they have accessible financial planning. What does that mean? It means that you don't have to have a big fat account. You don't have to have a ton of money that's set aside somewhere. You're not going to pay a ton of money in fees. You're going to get flat fee, conflict-free planning. You're going to get it from dedicated certified financial planners who are really trying to create a goal-based financial planning program for you. So check it out. The information is at facetwealth.com. Okay, so tax time, financial planning. We're getting back to our main interview with Ed Slott. And in this part of our interview, we're still talking about some of the implications of this terrible COVID era and how you have to deal with it in your tax life. So we're going to get to the more general stuff as well, but so much of the world was impacted by the CARES Act, and so many of you have asked these questions. So that's what we're going to do. We're going to stay on this subject. Here's more of our interview with tax expert and IRA expert, Ed Slott. So unemployment, stimulus checks, early withdrawals, are there any other provisions that you, from the CARES Act or from last year, that you think are going to be important highlights for the coming tax season?
Yes, the 1099s you're already receiving may not have these distributions. Let me give you an example. Some people took RMDs, required minimum distributions, early in 2020. They didn't realize the CARES Act would come around, and we've gone through all of this, and then they started screaming, I didn't know we didn't have to take them. Now I want to put the money back, which lots of people did. IRS provided all kinds of relief. If you had certain extended dates reverts. They don't matter anymore because we're past that. That train has left the station. But people were able to put it back and eliminate the income from that RMD. But here's the problem. These won't show up on the 1099-R. Let's say your RMD was $10,000 and you took it, but then you returned it. So in your mind, it's a wash. But not on the 1099. The 1099-R you're going to receive is going to show a taxable distribution of $10,000. It's up to you on your return to show that it was rolled over and zero amount should be included in income. You're going to have to know that. So if you typically just hand over your papers to a tax preparer and don't tell the tax preparer, you're going to see that return come back with that RMD income. And then you're going to scream, oh, no, I returned that. Well, then you have to show it as a rollover. Or worst case scenario, you do nothing. And that I can see happening because in your mind, you're saying, well, I took it and I put it back, nothing to do on my return. Then in about a year or so, you'll get one of those love letters from IRS saying, you owe tax on $10,000. The 1099-R shows you took $10,000. And then you're in a letter writing campaign that may exceed your life expectancy.
I mean, that is really interesting because what people don't maybe understand is that, you receive a document, but also the institution is sending the document and that institution is reporting it. And that's why the IRS has the information, right? And it's not their job to sort of say to the IRS, hey, Ed didn't actually need this. He put the money back in, right? That's your responsibility.
Yeah, you're going to have to know that if you're doing your returns yourself, or alert your tax preparers to let them know that you put it back. Or you may have put some of it back and not all of it. So you're going to have to go to your records. Now, you will get a tax form, usually after tax time, Form 5498, to show that you did a rollover. But that's not what IRS uses to see how much you took and how much should be included in income.
It's funny because as you say that, I'm wondering if you think that, I know there's a lot of people who do their own stuff. Do you think that because this year was so strange for many people, it behooves them to maybe seek the assistance of tax professionals or a tax service?
Well, if they're not sure, a lot of people may be confused about this back and forth with the required minimum distributions. You took them and you put them back. So if you're not sure, I would get help because all of this is matched to the 1099-R. That's the Bible. If it's wrong, it's still the Bible. Then you have to prove why it's wrong. Another area where we see issues, which you're going to have again, is anybody that took advantage of what I consider one of the best provisions in the tax code, qualified charitable distributions, QCDs, the ability to give right from your IRA to a charity. If you're giving anyway, that's the way to give. The only negative about it is that it doesn't apply to enough people. It only applies to IRA owners or IRA beneficiaries who are 70 and a half years old or older. If you do qualify for that, this is the way to give. Most people, as you know, over the last couple of years since the tax change, do not get any tax benefit out of the money they give to charity because most people take the standard deduction. 90% of the people take the standard deduction. Most people don't itemize because of the large standard deduction. If you're going to be giving anyway and you qualify as an IRA owner and you're 70 and a half years old or older, then this is the way to give. IRA money is the best money to give because it's loaded with taxes. Why not give that pre-tax money as a direct transfer from your IRA to charity? So that some people may have done that. Now, it was a little quirky last year because we had the Secure Act. We had these overlapping tax acts, the Relief Act, the CARES Act, the Secure Act. In the Secure Act, the Congress raised the age for taking RMDs, required minimum distributions, from 70 and a half to 72. But they left the QCD age, the qualified charitable distribution age, at 70 and a half. So you have a gap. So some people, this is another area, Jill, where people might get mixed up and say, oh, maybe I don't qualify for QCDs that I took because I didn't start RMDs. No, there is that gap. You can take QCDs even before you start RMDs. I feel like I'm talking an acronym language. If you did a QCD, that's not going to show up on the 1099-R. And let's say you take a $10,000 out of your IRA. Now, you notice I didn't say, because this is 2020 we're talking about, I didn't say it was an RMD because there weren't RMDs. That was my point. You could have done the QCD anyway, even though there were no RMDs. So let's say you took $10,000 out of your IRA to give to charity last year in 2020. Your 1099-R, just like with that RMD issue we talked about, is just going to show that $10,000 came out of your IRA taxable. Again, you have to put that on the return that went directly to charity to offset that income.
So do you think that the tax code change, which occurred, I guess, in December 2017, that was supposed to make things easier? Did it?
I think in some respects it is. You know, if you take away people's deductions, it's less work and record keeping they have with everybody taking the standard deduction. But lots of people were out that were not getting the big deductions that they thought they would get, specifically state income taxes. That was the big hit for the high tax states like New York, California, other states that were limited to $10,000. Most of those people ended up taking the standard deduction. So from a preparation standpoint, it was a lot easier. People that had work-related expenses, that whole section of the tax return where you used to add up your car expenses and your meals and entertainment and travel between jobs and all this work-related, that's all out.
We'll get back to our interview with Ed Slott in just a minute. If you've got a financial question, and maybe it's a tax question, it's Ask Jill at JillOnMoney.com. We'll be right back.
Do I invest here? Should I put my money there? Jill Schlesinger can help you. Back to Jill on Money.
You're back. It's Jill on Money, and we are talking to Ed Slott because it's tax season. I know how much you love this. Let's get right back into it. Our conversation with Ed Slott continues right now. Again, if you got a tax question, ask Jill at JillOnMoney.com. Let's go back in time a little bit and just do tax planning 101. What do most people goof up when they're filing their taxes, Ed?
The record keeping. Lots of people have a bunch of IRAs and 401ks where they're taking money out. Now, that should be a little easier this year because RMDs were waived for everybody. So maybe you won't have all of that, but that's going to come back in 21. You have to make sure you take your RMDs. They're resuming in 21. So you have to do all your calculations if you have multiple accounts like that. The other thing that I'm seeing, I was just speaking to an estate planning attorney, and he's saying, and I heard this from others, that going back to COVID, we're always going to go back to COVID, no matter how you want to put it in your rearview mirror. I don't see it disappearing. He said business is booming. People are updating their estate plans. They're worried about things because of COVID. Am I going to get sick? Am I going to die? You know, updating powers of attorney to make sure other people can act for them if they're too ill to act for themselves. In fact, what I'm hearing now, coming back to RMDs, young people, like people in their 40s and 50s, that's young, Jill, 40s and 50s is considered young now, who never had to worry about RMDs. We're getting questions from more of them helping their parents or grandparents take RMDs. Some of them got sick. They didn't want to make sure they didn't miss out on anything. So we're seeing those people get into rules that really never applied to them. On the estate planning, you should, as a general rule, take out your beneficiary forms. This is good planning at any time for anyone. A lot of people miss out on this. They name a beneficiary for their IRA. Maybe they did that 20 years ago and never looked at the form. Some people have died. There's been changes. You should update that to make it coincide with your current plan. The reason I mention this because the Secure Act that we talked about changed a lot of the post-death plans that people had made. It eliminated the so-called stretch IRA, that ability for your non-spouse beneficiaries, your children and grandchildren, to extend distributions out over their lifetime, 20, 30, 50 years. Now that's been limited for most non-spouse beneficiaries, spouses are unaffected, to 10 years after death. That may not coincide with the plans you made, especially people with the largest IRAs that may have named a trust as their IRA beneficiary. Those trusts may not hold up, so you should look at your IRA and plan beneficiary forms. They should be updated in general anyway whenever you have what I call a life event. What's that? You had a birth, a death, a marriage, a divorce, a remarriage. You had a change in the tax laws, a new grandchild. These things have to be updated. Or in the COVID area, we're seeing people that their plans have changed. Maybe they were going to leave their IRA to their two children, and one child is doing really well, but the other's in hard times. They had them equal. Maybe they want to adjust that. So you really have to look back at these documents. They're all coming back due to changes in people's lives.
I have to tell you a great story. I was a young financial planner, probably in the early 90s. And I had a couple came in, second marriage for both. And I asked a question, which I thought was a pretty easy question, right? I just said, who's Mary Smith? Like that, like very nonchalantly. And the woman looks at me. I mean, I thought that there was like daggers coming out of her eyes. And she was very quiet. And she turned to me and she goes, "Why would you mention her? That's John's ex-wife."
I knew you were going to say that. It's the ex.
Yeah. And I said, "That's funny because she's the beneficiary of his $500,000 401k account." And it was just a crazy team. So great advice there to update the bennies. 2021 tax filing. There are a lot of people who may have made Roth contributions because their income was down. They converted from traditional to Roth IRAs. What do they need to know about when they file their taxes? They'll get forms from their brokerage firms, right?
Right. They'll get that same 1099-R. It'll show a distribution. It'll be coded as a Roth conversion, but you owe tax on that. And that's not a bad thing. I was advising that big time, especially for people whose incomes were lowered in 2020, mainly because of the pandemic. We saw even business owners that had these small pass-through businesses like the little restaurants, the retail shops that were really hurt in 2020. They had these pass-through entities like the S corporations, sole proprietorship, partnerships, LLCs, all of that. And their business losses sometimes gave them negative income. And we encourage them, if you have negative income, I know that's a horrible thing, but if you have an IRA, convert that to a Roth. And many of them did. Now, that may cost them nothing or very little. That was a good move. And I would look at that again if there's some spillover to 21 and you see your income going low. First, yes, you will pay tax, but it may not be as much as you think if your income went down. And remember, we're in the lowest rates you may ever see in your lifetime. That's the key to all good tax planning. Always pay taxes at the lowest rates, even if you have to pay them up front. That's the thing people can't get their head out of it. They say, why would I pay taxes up front? To have more later. It's prevention. I call Roth IRAs tax insurance. It's like you're buying an insurance policy against the uncertainty of what future higher taxes can do to your standard of living in retirement. Better to pay a little now than have a big bill later. And with the market, the market has built up a lot of accounts. That means the tax bill coming is building. So yes, on 2020 returns, you will include that as income. You'll pay the tax. And don't worry about that. You made a good move. I love tax-free because you keep 100% of your money. And the reason I love Roths because people say, Ed, what if tax rates don't go up? Or what if they even go down? Highly unlikely given our level of deficits and debts. But even if I'm wrong about the rates going up, that you should convert. The worst case scenario, I'm wrong. Your worst case scenario is you locked in a 0% tax rate for life. And you can't beat a 0% tax rate. They're not going to pay you to do it.
Okay, we'll get back to our interview with Ed Slott in just a minute. Hey, during the break, why don't you go to JillOnMoney.com and sign up for our free weekly newsletter? Sometimes we link to stuff that Ed Slott does. Kind of cool, right? Okay, we'll be right back.
.401ks, IRAs, refinancing, she covers it all. Back to Jill on Money with Jill Schlesinger.
You're back. It's Jill on Money, and we are broadcasting from the Capital One Bank virtual studios. Capital One, this is Banking Reimagined. What's in your wallet? What is? Okay, we are talking taxes. Tax season opened officially on February 12th. As of right now, the tax filing deadline remains April 15th. Now, I hear whispers that if we get a stimulus plan passed, they might extend again. Mark, I didn't tell you that. I found that out over the weekend, last weekend, that is, that there could be an extension of tax filing. Now, because so many of you are due a refund. Not that I think that's the greatest thing in the world, but you are. It may behoove you to get those taxes done much more quickly. You want that money in your pocketbook. And again, for those of you who think you're due stimulus checks, you're going to have to go through the IRS process of making sure that you get that payment, that economic stimulus payment. You're going to have to try to get that recovery rebate payment. So, all right. So we're in more general tax stuff right now. We're talking about required minimum distributions and the impact on Medicare with Ed Slott, IRA expert and CPA. The required minimum distribution can shift some of the taxability around your Social Security, but more importantly, the Medicare income planning. So can you talk a little bit about that as well, how Medicare can get screwed up because you have too much income later in life?
Right, right. And this is a tricky part. The Medicare, we're talking about what's called IRMA charges, income related monthly adjustment amount. Anybody on Medicare knows what that is. So it's the IRMA charges for parts B and D. They increase as your income increases. But here's the tricky part about planning Medicare surcharges. Number one, it's not like you see it on a tax return. With Social Security, as you mentioned, as your income goes up, more of your Social Security can be taxed, and you see it on the return. Medicare surcharges don't show up on a return. They're invisible. They're separate bills. Comes right out of your Social Security, or you pay it directly. Plus, there's a 2-year look-back rule. So if you do a conversion now in 2021, you won't see the increase in the Medicare surcharges till 2023. So you might say, whoa, I did this conversion. I guess Medicare forgot about me. Woohoo! And then in 2 years, they catch up and they take your 2021 income to determine what your 2023 Medicare surcharges are. Here's a good strategy you can use for Roth conversions if you're worried about that. What you can do if you're under 63, now this is not everybody, but I'm sure there's somebody listening that might say, oh, that's a great idea. So why not give it to them for that one person, okay? Convert at age 62 or earlier. If you convert at age 62, by the time Medicare gets it, it'll be 64 before you start at 65. So it won't affect your future Medicare surcharges at all. Whereas if you did it a year later at 63, and this is where people mess up, oh, I'll do it at 63. Nope, you're still going to get hit because Medicare will put that in for the year you turn 65.
Before we let you go, two things. One is people are going to start doing their taxes and they are going to say, I bought a new monitor so I could work from home. I got some ring lights. I got a stand-up desk, and I cannot wait to deduct that. And since the vast majority of these people are employees, could you be the killjoy for this part of the segment?
It's great you made yourself more valuable, but there's nothing you need to do. Here's the good news. You won't need any receipts. You won't have to figure out how much time you spent and what room did you use, because none of it is deductible thanks to that Tax Cuts and Jobs Act. Remember that we talked about that made your life so simple? Mm-hmm. See how simple it made? No deductions unless you're self-employed. Then it's another story.
And then you can write off whatever,
Oh, yeah.
And what if, a lot of people did start some businesses. I noticed that business formations were up pretty big in the second half of 2020. I mean, how much can you reasonably get away with? Let me give you an example. Get laid off from CBS News, start a production company. Right? Okay. Now I have to go out and buy my equipment, camera equipment, editing equipment, and I have maybe one client. So maybe just I made 15 grand in business income and I have $15,000 of expenses. Can I just say, okay, I netted zero?
Yeah, you can do it. There's different ways to do it. Some of them can be expensed. Some of them, even if they qualify as equipment that normally has to be depreciated over so many years, you have the one-time expensing, and that falls under the limits for that without getting into the details. So you can expense that. It's called Section 179 depreciation. So things that have longer lifespan, you could still deduct those. And you may end up one of those people with the startup. You might have negative income. Ooh, do a Roth conversion.
Oh, I love it. I love it. I love it. Okay. Now, before we let you go, tell us about your new book. I'm very excited.
Well, it's called The New Retirement Savings Time Bomb. So now you're going to say, well, Ed, you mean there was an old retirement savings? Yes. And now there are new and more severe threats to your savings. Look at all these tax laws. Look at possibly increasing taxes on your IRAs and 401ks. So I created in The New Retirement Savings Time Bomb an easy 5-step plan to make the tax laws work for you instead of against you. And the bottom line is so you can have more, keep more, and make it last.
Thanks so much to Ed Slott. He is just the best, isn't he, Mark? The best guest to talk about taxes. He's so enthusiastic. He makes it really easy to digest. So we thank Ed again. We'll link up to his website. It is very easy, irahelp.com. Okay, when we return, just a little bit extra. One more question from you guys. Okay, we'll be right back. You're back. It's Jill on Money. I just want to thank Ed Slott again for joining us. He's so fantastic. His website, in case you may have missed it as we were talking, is irahelp.com. irahelp.com. And Mark will put a link to that in our show notes. He'll also make sure that we have a link to his book, which is coming out. Mark, do you see I'm getting wrangled into doing a book event for Ed? Anything for Ed is what that's my theory in life. Anything for Ed. Before we go, Mark says we've gotten a bunch of these questions that are very similar. This is from Marjorie, who says her accountant recently brought this to her attention. She said the last stimulus payment, she says, evidently we received it, but I thought the letter and the firm paper attached card was a fraudulent scam. So I shred it, meaning a lot of people got these payments and they came as debit cards and they think that it's just like a solicitation and they got rid of it. And she says, I assumed it would be a check, like the first stimulus check. Can you advise me how, what, who I can contact to retrieve the payment for me and my husband? Okay, here's the deal. Replacing any lost or erroneously shredded cards requires you to call Meta Bank Customer Service. And that's the bank that's mailed the cards, and you got to pay a fee to get a new card shipped. Ay, ay, ay. That's a drag. You can call, you ready for this number? It's 800-240-8100. You don't have to know the card number. You're going to have to provide your social, and that's going to be a problem, but give that a shot. Hopefully that works out. All right, everyone. Thanks so much for listening. Thanks for your great questions. And we're going to have another great show next week. But if you can't wait till then, just go to our website, JillOnMoney.com, and subscribe to our daily podcast. It's daily, which is fantastic. So check it out, JillOnMoney.com, the pod. Go subscribe. Hey, thanks so much for listening. As always, wash your hands, wear your masks, maintain your physical distancing. Try to lift someone up today. It's going to make you feel better, and it's going to make them feel better. We'll talk to you next week.